Hello there, this is Dominic at Hargreaves Lansdowne. I hope you're doing well. Thank you for registering for the Accessing Your Tax-Free Cash webinar. There's quite a few things that we'll go through. We'll run through a brief agenda, but before we do, I'd let you know that the webinar itself usually lasts about 20 minutes or so. If you do have any questions at all, do feel free to contact us. Throughout the webinar, I'll be giving you a few details and there will be information at the end as to where you can contact us and perhaps receive other bits of information that you might find to be of use. The webinar itself is information as opposed to financial advice. So really it means that I can tell you what the different options are, but we won't be able to tell you what the best option would be in your particular circumstances. The reality is that everybody's circumstances are different. If you do want more information, do feel free to contact us. But if you're looking for advice, then you may need to speak to a financial advisor. So in terms of what we'll cover today, first, we'll have a look at how pensions work to make sure that everyone's on the same page in terms of what we're talking about. We'll then have a look at how you can access your tax-free cash. Ultimately, to access your tax-free cash, you need to decide what you're doing with the rest of the pot at that time. So that's where we'll spend the bulk of this presentation. The next thing we'll look at is considerations, so perhaps a few questions that you might need to ask yourself to try and decide what will be best for you. And like we said, in every circumstance, it's going to be a bit different. So we'll just give you a few ideas of what you should be thinking about to be in the right ballpark. So when we talk about pensions, this webinar is focused predominantly on what we call defined contribution pension schemes. Some of you I know listening in will have defined benefit schemes. Now it's best to speak with your provider in regards to what your options are with that. But for this webinar, we'll focus mainly on defined contribution. Now, the way those pensions work is that there's really two key things that you can amend to make sure you're getting the most out of your pension plan in terms of what decides how big that pension will be when you get to retirement. And the first element is your contributions. So as you'd imagine, the more you put into your pension, the more you would hope to get out when you go to retire and to access the pot. The issue is it's not as easy as that. As just putting in as much as you can and then it kind of growing over time and so on. If you're just putting money in there and it's not growing very well, or it's even in some cases it could be going down in value, then the reality is you might not get out as much as you planned for in retirement. And that's where the second element comes in, which is the investment side of things. And it's a combination of how much you put in and how hard that cash works for you. So where it's invested and how it performs, that will decide how big the pension is and ultimately how much tax-free cash you could have in total. So when you do get to retirement, so currently from age 55, you can access your personal or workplace pensions for the most part. The state pension, you might be aware, is a little bit later than that. So it's actually 65, moving to 67. And again, that will depend on your date of birth and so on. But looking at personal or workplace pensions at age 55 and beyond as well, you can access up to 25% of that pot tax-free from that age onwards. And that's what we're here today to talk about, is how you would get hold of the 25% and what the options are for the remaining 75%. So in regards to your options at retirement, you may be quite familiar with these, but really to take the 25% tax-free, you have to decide what you're doing with the remaining 75%. And we've broken them down here into three kind of very basic retirement options, which we'll analyze a bit closer throughout the webinar. Firstly, an annuity, perhaps the oldest method that's out there for accessing pensions. An annuity is a secure income for the rest of your life. So the idea is you would take 25%, move the remaining 75% into an annuity where it'll pay you a fixed amount for the rest of your life. Drawdown is a bit more flexible. And the idea is that, again, you could take up to 25% tax-free, move the remaining 75% into a drawdown account where it's still within a pension, really. You can still manage the investments. And from that, you can draw as much or as little as you like, kind of like a bank account in a way, in that you have that flexibility to change your withdrawals. But there are a few issues with that as well. There's a downside, I suppose, to flexibility, but we'll discuss that later on. And then finally, a lump sum withdrawal, which is the ability to take lump sums from your pension. And of each lump sum that you take, 25% could be tax-free. You might have seen it called an uncrystallized fund pension lump sum, UF plus for short. But again, we'll focus on that in more detail. I'd point out at this stage, you can mix and match. Often when we kind of talk about this, we provide these webinars, one of the first questions is, well, I want a bit of both or a bit of each option. And that is something that can often be done depending on who your pension provider is and what options they allow. So through Hargreaves Lansdown, you could use some of your pot to purchase an annuity. You could use some of it to buy to kind of set up a drawdown account or any of the other options, really. So it is very flexible compared to what it would have been back kind of 5, 6, 7 years ago. So all the while we look through these different options, there's a few things you might want to consider when you're looking at what might be best for you. The first is, do you want a secure income? An annuity is a truly secure income because it's backed 100% by the government. So once it's set up, you know that's going to pay to you until you pass away. So there's security in that, knowing that you don't have to manage it and that you know exactly what's going to be paid to you monthly or yearly or however you've set that up. Will your income needs change? Now, that's one thing to think about, is that if you set up an annuity and suddenly you need a lot more in retirement that you planned for, there's not much flexibility with that. You're not able to change them in most cases when an annuity has been set up. So again, you come back to whether you want drawdown or the lump sum option, which tend to be a bit more flexible. Do you need all of your tax-free cash now? Again, a phased approach is something that's available, so you don't necessarily have to access all of your pension in one go. You might have multiple different pension pots. You can access one at a time if you wanted to. There's many different ways to kind of phase your retirement. It's not that you have to take a full 25% straight away. You could split your pension into smaller portions and take 25% of each portion. And one thing again to think about is what happens when you pass away. An annuity, in most cases, tends to stop if you pass away, unless you've built in any kind of protection there, a guarantee period for it to pay on for another however many years, or a spouse's pension and these kind of things that can be built in. With drawdown or anything else left in a pension, it's actually a really tax efficient way to pass things on, because usually a pension is held in trust, which means that you don't, it's not subject to inheritance tax in most cases because it's outside of your estate. So again, that's going to be another key consideration when you're considering the different options. So we talked very briefly about an annuity. It's a secure income, a secure regular income for the rest of your life. And initially, you can get up to 25% tax-free. From the remaining 75%, that can be subject to income tax depending on your tax situation at that time. Now, if you're getting an annuity, you're also getting perhaps the state pension as well. That can push you into a bracket where perhaps you are paying tax. And we'll look at a few worked examples of that shortly. But the key thing with an annuity is that it really is a secure income. Perhaps a con of that would be, or a downside would be, that it's not as flexible as some of the other options, which is why in 2015 we had the pension freedoms brought about to give you many other options, as annuity rates have a very low rates at the moment, though that can change fairly regularly. We do have an annuity calculator through our website, so you can pop in the values of your pensions and so on, and it'll give you an idea as to how much you might expect per year based on the annuity that you'd like to buy. I would stress that putting in details such as height, weight, and so on, any kind of lifestyle details that you can when you buy an annuity, can really help you in terms of bulking up the amount that you would get from the annuity provider. It's probably the one time where smoking 20 cigarettes a day is probably kind of helping you out. So do give any information that you can to the annuity provider, because often that will lead to a higher amount for the rest of your life. But we'll work through an example of how this might work. Let's say the pension pot is £100,000, and this person has chosen to take 25% tax-free and move the rest of it to buy an annuity, so to give it to an insurance provider. So they run through the calculator, they see what rates are there, and they decide, well, actually, yep, I'm happy with the amount that's paying. They choose to proceed with an annuity. In this example, they receive £25,000 tax-free. The annuity provider has given them a rate of 3%, so they're looking at about £2,250 per year from the annuity provider from that £75,000. The state pension, roughly speaking, is about £9,100. Again, that will depend on your circumstances. We are running a state pension webinar, so do tune into that for more information on the state pension. You can check that online through the gov.uk website and to get an idea about how much you might get from that. But in this circumstance, this person has 35 years of national insurance contributions. So they're looking at receiving around about the full state pension. So how this pans out is 25,000 was received upfront. The remaining for the rest of their life now, they'll be receiving 11,350 per year. Just based on this pension pot here, we're using very round figures. As I said, you can check the annuity calculator to get a more applicable picture, if you like, in your circumstances. So moving on to drawdown, another really popular option at retirement. There have been a few changes to kind of liberate these pensions in a way to make them much more flexible. So the way that drawdown works is you receive 25% or up to 25% tax-free from the outset. And then with the remaining 75%, that is moved into something called Flexi Access Drawdown. Now, from there, it remains invested. So you can invest it with Hargreaves Lansdown over around about 3,000 funds, individual shares, bonds, ETFs, a whole range of different investments. But you've got the kind of ability to manage that as you see fit. Now, that can still fluctuate. Whereas with an annuity, it was a fixed amount and that paid until you passed away. With drawdown, it depends how it performs, I suppose. It could do very well and there could be sizable growth there, which might mean that the pot lasts a lot longer. Likewise, we've seen a recent significant drop in the market. And if you are in drawdown or close to retirement, that can have a very big impact on what you can actually do with that fund. So the issue with drawdown is if it was to drop in value, then you might have to limit how much you draw from it to try and keep that pot in place to pay until you pass away. Now, there is a drawdown calculator on our website where you can again put in the details of your pensions, what the estimated value would be, and it'll give you an idea based on assumed growth rates, how long that pot might last on a kind of certain level of income that you choose to take. And that's quite useful for planning. So I would say, please do check that out and see how that would work for you to understand if this would be a viable option. With drawdown as well, the remaining 75% is usually moved into a drawdown account where, again, it's held outside of your estate. It's held in trust, which means that if you were to pass away, then the pension usually passes on free of inheritance tax. The key age to look at with your pension funds is 75. If you pass away before age 75, usually your pensions would pass on to your beneficiaries who you've nominated, completely tax-free. No inheritance tax and no income tax for the most part, though again, it will depend on your circumstances. If you die after age 75 and you've got funds in drawdown, that can pass on still free of inheritance tax, but your beneficiaries could pay income tax as they draw from it. And now it's down to them whether they take it all as one lump sum and pay what could be quite a large amount of tax, or whether they kind of drip feed that over time. But there are ways to manage that tax efficiently. So it's worth being aware that drawdown does have this benefit that it's outside of the estate. Now, we'll look at another example here to kind of work through how drawdown might work practically. So if your starting pension pot is again 100,000, you might choose to take up to 25% tax-free. From the remaining £75,000, this person has chosen to take £5,000 of income because they've had a look at the calculator. They think that's a fair amount to withdraw and it's enough to provide them with their needs for that year. On top of that, they might have the state pension. Now, those two figures combined takes you to about £14,100. Now, you can earn up to £12,500 tax-free, depending on your circumstances, but that is the personal allowance. Now, because the state pension and the income from drawdown will be above that, they actually pay £320 in income tax. Some people assume that the state pension is tax-free, but actually, the belief is because it's within your personal allowance that you don't pay tax on it, but it can push other forms of income into a tax band where you might pay 20% or even more. So as a net figure, in this instance, they've received £25,000 as a lump sum. And if they've taken £5,000 for this year, they've received £13,780 as an income. Now, you can do a partial withdrawal. You don't necessarily have to take the full £25,000 in that example and move the remaining £75,000 all into drawdown. I'll show you an example of how this would work on a partial basis. Now, this person wants to take £10,000 and moves only some of that into drawdown. Now, the way this would work is that the £10,000 of that, 2,500 is tax-free. So 25% of that smaller amount is tax-free. And the remaining 7,500 is then moved into drawdown, where that can be invested. And alongside that 7,500 in drawdown, they still have £90,000 left in a pension pot. That 90,000 could fluctuate depending on how the investments perform. It could go up, it could go down. But ultimately, from that 90,000, you could repeat the process. So later on down the line, you might think, right, well, now I want to take some more tax-free cash, move some more into drawdown or into an annuity, or even take another lump sum, of which 25% could be tax-free. So hopefully this highlights how it's not a kind of take everything in one go. If you don't want it to be, you can spread things out to suit your circumstances. Now, the lump sum withdrawal came about in 2015 as part of the pension freedoms, which some of you may remember kind of being brought out. And it's a little bit different. It's similar to the partial arrangement that we've just looked at. But the difference is the 7,500 in that example won't be moved into drawdown. It will be paid out directly. But we'll look at that briefly in the next slide. You can double check online through the pension income tax calculator to understand what kind of level of tax you would pay, because with the lump sum withdrawal, 25% is tax-free, but the remaining 75% is taxed at that point, whether you take the whole pension or a smaller lump sum. It's the lump sum that you withdraw, which is taxable. So I'll show you here a kind of full withdrawal, if you like, through the lump sum method. Now, in this scenario, the pension pot of £100,000, they're taking the whole lot, £25,000 tax-free, the remaining £75,000 as a lump sum. The issue there is that's a significant amount to take in a tax year. If you add on the state pension as well, this individual is paying about £21,000 in income tax. And that will again depend on your circumstances and other forms of income that you have elsewhere. So as a net figure from this pension pot of £100,000, they've been able to withdraw just under £63,000, and the rest has simply gone on tax there. So we've had a look at a few options there, and ultimately the takeaway is that to access your tax-free cash, you need to decide what you're doing with the remaining 75% of whatever it is that you're taking, whether you move it into drawdown, use it to buy an annuity, or withdraw that as well and potentially pay tax on it. With the tax-free cash, deciding on when might be right to take it, do consider things like future growth. A lot of time people say, well, I might just withdraw it at 55 and let it sit in a bank account. But the issue in that scenario is that you've withdrawn it from the pension. It may no longer be protected from inheritance tax if you were to pass away. And it may not grow as tax efficiently if it's not in a wrapper such as a pension where there's no income tax or capital gains tax on your investments. So it's weighing up, well, if my pension might grow in the future, I might be able to receive more tax-free cash, though the issue there, of course, is that it's not guaranteed that it will grow over time. So again, inheritance tax protection is a big consideration that often gets overlooked. So I would say do think about that when you're looking at your options. You may want to consider kind of improving income as well, so on. So for example, the longer that you leave a pension invested, the likelihood tends to be that you would receive a higher annuity, because I mean, the older you are, usually the higher annuity rate that you could receive. So these are the key things to think about. It's your decision. You do have the freedom to access your pension from a whole plethora of different options that we've looked at from age 55 onwards at the moment. So our aim here, I suppose, is to arm you with as much information as we can to make sure that you're in a good position to make an educated decision. Now, it's not just us who are here to help you. There's plenty of other avenues that you can go down, and I would say it's worthwhile getting as much information as you can before proceeding. Now, PensionWise is something that I'd like to point out for you. It's a free and impartial service for anybody aged over 50 who has a workplace or a personal pension. And really, they were introduced to help you understand your options, because I think in 2015, when the pension freedoms were brought out, there were so many new options that it was very easy to get lost in understanding all the new terms and what the options would be. PensionWise is set up to help you understand those options. Now, they can be contacted online or by telephone. You've got the details there. They may be local to you as well, but I would say to check online to get the ins and outs of how that would work. they're on hand to walk you through the different options that are available. But of course, you're very welcome to contact us directly if you do have any questions and need any information. I'd also point out we do have an options at retirement guide available through the Hargreaves Lansdown website. So if you do want a bit more detail, please do download that. It's free to download. Just log in. You get a PDF document with all the information that you need then. So before we wrap up there, I've got a statistic here which is not designed to scare you, but it is something that's worth being aware of. You guys listening in, it's very likely that you're closer to retirement and maybe thinking about your retirement options, or you'd expect so, given the topic of the webinar. Now, it does mean that often you can be targeted for things like pension scams. It's actually estimated that the amount lost each year to scams and fraud is about £10.9 billion. You may have seen the adverts recently with the scammer on the jet ski and so on, using funds that they've kind of gained illegally. It's really worthwhile being aware of this. So just to highlight a few things to look out for. Firstly, if you're receiving contact out of the blue, things offering high return or guaranteed returns, those two things don't really go together. If it's offering a high return, the chances there's a lot of risk associated with it, and you wouldn't expect it to be guaranteed. Anyone providing free pension reviews, again, if they've contacted you out of the blue, that's going to be a warning sign. Often this can be used to get all the information that they can from you regarding your pensions. So do make sure if you're dealing with any companies, it's a reputable company. Kind of checking online, speaking to people as well, word of mouth, those kind of things can all be useful. If ever in doubt, I mean, these are the things to look out for, but do not feel rushed into doing anything. Accessing your pension now can take as little as 5 to 10 working days. So actually, it is a very quick turnaround. So don't feel that there is pressure to act very quickly. Just one thing that I would say, accessing your pension before age 55. To the best of my knowledge, my understanding is that that's only possible in the case of terminal ill health. So if that doesn't apply to you and someone is saying, yep, you can get hold of your pension before 55, that should set some alarm bells ringing, and you might want to speak to Hargreaves Lansdown, to PensionWise, or anybody else really, to understand a bit more about what your options are and to make sure that you're staying safe there. Now, if you do have any further questions, do feel free to give us a call. I've popped the Retirement Helpdesk telephone number there, which is 0117 980 9940. They're there to help you. So if you do have any questions specifically about the information that we've covered today, do feel free to give us a call. Alternatively, you can email us at retire@hl.co.uk. Or if you prefer, you're very welcome to email me directly, and I'll make sure that your questions are answered to the best of our ability. Now, before we finish things there, please do take a moment to read through the important investment notes. It's covering what we said at the start, which means that it's information as opposed to financial advice. So hopefully there's been a few things that you're able to take away from this webinar. It's also pointing out PensionWise and reiterating the details there. So do make a note of those and feel free to contact them for more information. It's a really important time when you're coming up to retirement and looking at the different options. So if there's any way we can help us, do let us know, but do please take the next few minutes to read through this slide. Okay, so thank you for listening. The contact details are available there. Again, hopefully there's something that you've been able to take away from that. Any questions at all, please don't hesitate to contact us. Essentially, that's what we're here for. Thank you very much, and have a great rest of the day.